Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal. In today's episode, we look at 4 big stories. First, we'll understand why Indian companies are not really investing. Second, after a decade of underperformance, both residential and commercial real estates are booming in India. Third, Shein is returning to India with the Reliance partnership. And finally, we'll talk about the fact that currency derivative trading is dying. Volumes are down by 90% after RBI's guidelines. So let's begin. Why isn't anyone investing in India? Look, this is how an economy runs. Someone thinks very hard about something that the world needs. He talks to other people, gathers resources, and constructs a factory. It is a big bet which may or may not pay off. The construction takes 2-3 years and it costs crores of rupees. All of this money goes to the suppliers, contractors, and construction workers. These people then start spending this money in the economy itself. Now, once a factory is constructed, every month the owner pays workers and suppliers. People spend all this money and it's back in the economy again. Now, with all this money up for grabs, others also start taking their own bets. Someone sets up a business to provide raw materials to the factory. Another person builds an apartment complex near the factory. Basically, all of them spread more money around the economy and repeat this cycle. Now, over time, a neat little business ecosystem develops of the initial investment. That is why investment is the heart of the economy. A good investment just does not add to a country's GDP once. Its effects are felt again and again and they multiply through the entire economy. This is why it should scare you that in the first quarter of this year, private investments announcements are at a 20-year low at 44,300 crore rupees. For your context, this is 96% lower than the previous quarter. But what is wrong? See, there are many possibilities. First, this data comes from the Center for Monitoring Indian Economy or CMIE, which some people claim to be inaccurate. Now, we have no idea if this is true, but the problem is that we are lower than CMIE's own data from before, and directionally that is still a very big problem. Second, the problem might be because people were holding off their investments for the Lok Sabha election. See, typically the June quarter is not a very popular time for investments in any year. Now, had the ruling party changed after the election, the government would have altered its approach to business as well. So investors would have found it better to wait and watch. Now, on the other side though, during the last 2 Lok Sabha elections, which were also held in June quarters by the way, there were investment announcements of 2.1 lakh crores and 2.9 lakh crores respectively. This is 5 to 6 times the investment for the last quarter. Third, it is possible that private firms would like to invest but they can't find the money for it. Over the last decade or so, banks were under severe stress because of all the non-performing assets on their books. On the other hand, NBFCs also became risk-averse after the ILFS crisis. As a result of this, neither banks nor non-banks are particularly keen on corporate credit. Now, according to Oaktree Capital, there is currently a $300 billion funding deficit for Indian corporates. All of that money in an ideal world would have already entered the economy. Fourth, firms might believe that while India provides good business opportunities in theory, it is simply too risky. As we already mentioned in an episode last week, the Indian government has often flip-flopped on policy questions. This fills businesses with uncertainty. In fact, the government versus Vodafone fiasco in 2011 was an inflection point for the Indian economy, and Indian investments have never recovered to the same levels after that. Fifth, perhaps the most terrifying of the lot, firms may not even consider India to be a good market at all. See, it only makes sense to bet on a country where you think the bet will work out for you, which is that there are a lot of potential buyers for whatever you hope to sell. Unfortunately, Indians are not buying too many things. Consumption is growing at a very weak pace. There is no guarantee that any new business you open in India will have a lot of takers for it. In fact, Indians currently seem to be in a silent income crisis when they're earning less, saving less, and borrowing more. This makes India an unattractive bet for a business despite its huge population. Which of these is a real issue? Well, we're not quite sure. The truth perhaps is somewhere in the middle. All in all though, such low investments in the Indian economy is a big problem. Hopefully things pick back up over the next few months. Now moving forward to the next story, let's talk about the unreal growth of the real estate market in India ever since COVID-19. Look, India's real estate market has struggled since 2010. However, since COVID-19, the market in both the commercial real estate and the residential real estate sectors has seen a big boom. Recently, Knight Frank, which is India's leading property consultant, published a report analyzing India's real estate in the first half of the year. This report analyzed the performance of real estate across 8 major markets inclusive of Mumbai, Bangalore, Chennai and Kolkata. There were some really interesting insights about the industry in this report. Let me walk you through it, starting with the residential real estate market. See, ever since COVID, the residential real estate sector has seen a phenomenal recovery. Sales volumes have grown as much as 29% since 2020, and it even hit a 10-year high in 2023. 2024 has also been a great year. The momentum has continued in the first half of the year. Residential real estate has grown 11% year on year and has also touched a 11-year high. The demand is so strong that there is now a very visible premiumization of preferences among Indians who earn very well. Premiumization, by the way, is a trend where people are now looking to elevate their lifestyles. Also, this trend is not only limited to real estate, it is also very easily visible in things like FMCG, clothes, entertainment, electronics, etc. Now, to explain this premiumization, let me give you some very interesting numbers. First, houses priced above 1 crore rupees have contributed 41% of total sales in these 8 key markets. Second, sales in the 1 crore plus price segment have grown by a massive 51% year on year. Third, sales in the 50 lakh to 1 crore price range have dropped by 8%, and those in the below 50 lakh category have dropped by 6%. Now, why is this happening, you may ask? Two main factors. First, as we already discussed, the focus and preferences of home buyers have started to shift towards premium houses. Second, the interest rate on home loans have gotten higher. Plus, the lingering effects of the pandemic could be much more in the under 50 lakh customer base. The only negative point that this report highlighted was about unsold inventories. Look, while the overall inventories grew by 3% year on year in the first half of 2024, those in the 1 crore plus category saw a 27% increase. However, the report also mentions that the speed of sales has consistently increased. This means that inventory is not that big a concern at this point. The Knight Frank report also spoke about the commercial real estate market. Let me quickly walk you through what it said in 4 simple points. First, similar to residential real estate, commercial real estate has also hit record highs in 2024. The first half of 2024 saw the highest ever volumes in a half-year period. Second, Indian businesses seem to be flourishing and are increasing their commercial real estate leases. Such transactions have jumped from 35% in the first half of 2023 to 41% in the first half of 2024. Third, foreign companies aren't sitting quietly either. In the first half of 2024, they leased 48% more space than they did in the first half of 2023. Fourth, because of the strong residential market, most developers have focused on that very market and new commercial project completions have gone down. Now, this has led to commercial real estate inventories dropping to single digits in some important markets. The lack of new supply is also forcing rents to go up. Now, moving on to the next story, we'll talk about how Chinese giant Shein is coming back to India. Do you remember the time when the Indian government banned several Chinese apps back in 2020? Shein was one of them, and when this happened, many fast fashion enthusiasts were absolutely heartbroken. But there is some interesting news. It seems like Shein is making a comeback and Reliance is helping them return to India. How and why? Well, before getting into those details, let me give you some quick background about Shein. First, the company started in China in 2008 and very quickly became popular for selling clothes at dirt cheap prices. Now, in order to keep its customers happy and hooked, Shein changed its inventory almost every single day. This way, its customers were happy that they were up to date with the latest fashion trends. How they did this might sound cliche, but it's still very interesting. The answer is technology. Look, Shein's internal software connects its entire business right from design to delivery, and all of it is optimized with data. Shein suppliers get their own accounts on the platform, which gives them access to data on what styles are selling and what customers are really looking for. The Shein platform also predicts what customers would be interested in the future. Now, this system has been so powerful for Shein that even though they lost a large market like India after the 2020 ban, their growth did not slow down. Shein kept growing at unreal speeds across the world and became a dominant player. I'll give you 2 very interesting numbers that are sure to surprise you regarding this. First, in 2023, Shein sold goods worth $45 billion and ended up making a profit of $2 billion. Second, Shein also raised $2 billion at a mammoth valuation of $66 billion. But now here's the thing, Shein has also been involved in multiple controversies. It has been accused of forced labor and causing serious environmental damage. Why? Look, fast fashion products don't quite last long. They are not meant to. And because they are so cheap, people tend to buy more than they need, and that is the root of all problems. Now back to the main story, I'm sure you're all curious about how Reliance is helping Shein return to India. So let me tell you about it. Look, after the 2020 ban, all Chinese companies needed to follow a rule. They cannot directly enter India or make any investments without the approval of the Indian government. That's why in 2023, Shein formed a partnership with Reliance. Now here is how they're working around the rules. First, Shein has agreed to manufacture its products in India. Second, they will store customer data locally, which is important because the Indian government does not want Indian data to go to China. Third, Reliance will license Shein's brands and designs, and Shein in turn will receive a license fee from Reliance based on a percentage of profits. Fourth, Reliance will sell Shein's products on its app and all its stores. Now, why is this good for Reliance, you might be wondering? Look, while they have a strong retail presence, Reliance is not exactly known for trendy stuff. Now, this partnership lets them cater to a demographic that wants trendy clothes at cheap prices. The Ken also wrote about this very recently, and they very funnily called it the Gobi Manchurification effect. Basically, just like Gobi Manchurian is an Indian dish pretending to be Chinese, Shein is now a Chinese brand pretending to be Indian. Now with this partnership, Reliance will be able to compete very strongly against Zudio, Nykaa Fashion, Myntra and all other fast fashion brands in the country. And because of all of this, we are probably also going to soon see a strong price war in this space. Now moving on to the next story, we will talk about currency derivative trading and what is really happening there. In April 2024, the RBI pretty much killed exchange traded currency derivatives. This happened because they issued a circular saying that unless you have exposure to the underlying currency, you cannot trade currency derivatives. See, in theory, derivatives exist to help people hedge their risks. So let's assume you are an exporter and you sell goods in the US and earn dollars. Now you will have to convert these dollars into rupees. But if you are worried that the value of the rupee will fall within the time you convert, you could always use derivatives to hedge your risk. But in reality, most of the people trading currency derivatives were speculators. Now there's nothing wrong with speculating, but the RBI didn't really like this. So they said, unless you have exposure to the underlying currency, that is the rupee and the dollar, you have to stop trading currency derivatives. This meant that all retail traders that were trading currency derivatives had to stop and instantly volumes fell. As per the latest data, volumes are down by 90% and more. This also changed things for the currency derivative traders. This meant that speculative trading, where you try to profit from exchange rate movement, was no longer a thing. Currency derivatives could only be used for hedging. Now, hedging helps businesses and individuals protect themselves from unexpected changes in exchange rates. Take for example, an import-export company could use currency derivatives to lock in an exchange rate for their foreign transactions. Well, that's all the news I have for today. I hope you found value in this. I'll see you in tomorrow's episode. Take care and have a nice day.